With respect to equities in particular, typically when the interest rates are going up, that's not necessarily something all equities like. Did equities respond that way this week?
Yeah, David, and they've responded that way, since the late fall, when I think it became finally clear to investors that interest rates would have to go up, given the level of inflation we're seeing, the tightness in the labor markets, and the slowness with which supply is coming back online. And so, yeah, we certainly saw valuations come back and some come down in some places more than others. And that we just don't know for how long that's going to go on, which points to that big question that investors always face: do you try to time this market, or you just hold on for the long haul?
So, Bob, what about the Fed trying to time bringing it back down again? How risky is that? Because the track record on these so-called soft landings is not a great one.
So, David, we talked about this, when we talked in December. The Fed needs to begin moving. As of today, they're still very, very easy, ultra easy, I would call it. The balance sheet is still expanding. They're still almost $100 billion in security purchases each month, and I think it's time that they get on with it. So I think the sooner they begin this process of kind of easing into an economy that has recovered and is growing and has a very, very tight labor market, the better.
At the same time, Bob, you've got Omicron out there, you've got the COVID virus, and so you can't quite know where the economy is going. So how big a risk is it of that so-called policy mistake, stomping on the great brake too fast and leading us into, dare I say it, a recession?
Listen, it is. Everyone has said who's been on already, this is tricky. It's not 5-minute race to time this. But I think the biggest mistake that the Fed could make would be to delay too long, beginning to get to neutral. And I think, David, we've talked about this before, and Joanne and I have talked about this, but when the Fed goes from ultra easy to neutral, it's usually fine for the markets. That's been the history. We're not even close to neutral yet. So when I say begin the actions, what I'm talking about is getting closer to neutral. If you look at the futures markets, then they're expecting Fed funds, not this year, but at the end of 2023, Fed funds will be 1.5 to 1 3/4. Neutral is maybe 2%, 2.5%. And then I would just bring up, it kind of ages me in my experience on Wall Street. But if you look at the experience in the early 80s when Volcker had to really, put the brakes on, short rates got to 15 to 20%. So if we talk about getting short rates, overnight Fed funds, back to 2% or 2.5%, I think that's what we should be aiming for.
And to that point, Bob, you put it really in good context, right? This is not the 80s, right? Short rates heading to 15% is very unlikely for that to be in our future. So we're really looking at short rates in the 2-ish plus % range. And also, right, this is a very different economy from where we were back then in the 70s and 80s when we had to deal with those oil embargoes and the slowdown in production. This time, the Fed at least has a tailwind to help it solve the inflation problem in that more supply is going to be coming back online this year. Just look at the semiconductor industry, which is bringing new factories up and running and will be putting out chips starting mid-year. And that's going to help by bringing up supply. That'll help close that gap between consumer demand, which is incredibly strong, and the gap in supply that we've been suffering. That should also help to bring down inflation, even as those interest rates go up.
Joanne, some people think that the 2-ish is not enough, that they'll need to do more than that to get inflation really under control. You manage a portfolio, so you don't know where it's going to go exactly. How do you manage that portfolio to make sure you take advantage of any growth that's coming your way, but protect yourself on the downside?
Yeah, right. 2-ish is still leaving real rates negative, given the level of inflation we have and are likely to have for at least another year. And so what we try to do in portfolios is to provide some positions that actually do well with high inflation, or at least are protected from it, because with that high inflation comes rising interest rates. And so you can look at various companies, whether they be banks, insurance companies, that do better as interest rates rise, but also look at some of the retail players. They're the ones that are actually raising those prices that are showing up in the inflation numbers. So they're actually a form of protection against inflation because their sales will go up, their earnings will go up. And so long as they don't have too much in the way of labor costs, because wages are a real concern here, they could potentially even protect their profit margins as they've been doing over the last year. So there are ways to build that kind of protection into portfolios even with a rising rate and high inflation environment.
So, Bob, Joanne said the magic word, banks. You know something, little something about banks, I dare say. We did start to get some bank earnings right at the end of the week this week. And typically banks do better in raising rate environments. I'm not sure inflation helps them. What did you make of the earnings that we saw? Because it was really a mixed bag. It's only one data point, really a mixed bag. JP Morgan had what was, many would think were good results, but their stock got hit by it. Wells Fargo, not so good, but they actually did pretty well.
I think you said it perfectly, David. It was a bit of a mixed bag. On the one hand, this is a terrific year for banks. JP Morgan had a record year in terms of profitability. And I think one thing is certain, if we're correct that rates are getting back closer to neutral, higher short-term rates, steeper curve, it's really good for financial services. So those are the positives. I think the negatives are expectations are probably getting a little bit ahead of themselves. I think it's very hard to envision an environment where there's more deal making going forward than what we've seen in the last year and in the kind of numbers that we've seen this year. Those institutions with significant investment banking operations have done particularly well. And then lastly, as the CFO of JP Morgan said, they're targeting something like $3.5 billion in spending for technology and for acquisitions in technology. And remember what we talked about in December, which is that if you look at U.S. financial services prior to the crisis in 2008, about 95% of the market cap of financial services was the legacy banks. Today, that's closer to 70%, and we're seeing a big impact of technology platforms, monoline platforms competing with the banks. So I think there's a lot more competition, and so we're seeing costs increase. As you and I have talked about, that may be absolutely the right decision, but I think it was a bit of a surprise to the market.
Joanne, last word to you on this subject. Do you like banks for your portfolio, given where we are?
Yeah, we do. We do see those. We do see those rates coming up, and that obviously could help their net interest margins, but also recognize that a lot of people are now thinking the Fed's going to actually shrink its balance sheet potentially later this year. And they have a lot of longer term assets on that balance sheet. So that could also pull up the long end of the interest rate curve. And that also potentially increases their net interest margin even more than an increase in the short term rates. So we do think there's a fair bit of tailwinds in the outlook for banks. And we think they're an important, potentially protection against rising rates that will hurt some other valuations. And also we see loans rising over time. And not just the big money center banks, but also regional banks, I think, are a good place to be in this kind of a market because they're going to be more exposed to the increase in lending that we think is going to come along with continued economic recovery.